The jump from $5,000 to $10,000 is where investing quietly changes character. Up to this point, progress was driven almost entirely by your own effort, your contributions, your discipline, your consistency. But in this phase, something new starts to happen. The money begins to participate. This is the stage where many Americans first notice that their balance moves even when they didn't add anything. A good market week can add more than a full paycheck contribution. A bad week can erase months of effort. And that realization is both exciting and uncomfortable. For the first time, you feel the power and unpredictability of the market at a meaningful scale. This is also where mindset matters more than mechanics. Technically, you're still doing the same things, contributing regularly, staying diversified, avoiding emotional decisions. But psychologically, the stakes feel higher. Losing $200 no longer feels abstract. Gaining $500 feels earned even. Though you didn't do anything, this emotional shift is where many investors either mature or self-sabotage. The biggest temptation in this phase is overconfidence. When the account starts growing faster, people begin to believe it's because they're finally good at investing. They attribute normal market behavior to personal skill. This is dangerous. It leads to riskier bets, concentration in a single asset, or chasing whatever performed best recently. The irony is that success, not failure, causes most long-term damage here. The smarter response is humility. Recognizing that growth is coming from time and exposure, not cleverness, keeps you grounded. At $5,000 to $10,000, boring is still beautiful. Broad diversification still wins. Consistency still outperforms creativity. Another shift happens around this level. Loss aversion intensifies. When balances were small, downturns felt like learning experiences. Now they feel personal. This is when investors start checking accounts too often, reacting to headlines, and questioning long-term plans during short-term noise. The market hasn't changed. Your emotional attachment has. The solution is distance. Fewer logins, longer time horizons. Clear rules you follow regardless of mood. Many successful investors intentionally reduce how often they look at their accounts at this stage, not because they care, but because they care enough to protect their behavior. This phase is also where goals become clearer. At $10,000, investing stops being theoretical. You start imagining what $50,000 feels like, what $100,000 could do. Retirement, freedom, security. These ideas stop being vague and start feeling reachable. That clarity can be motivating, but it can also create pressure. The key is remembering that speed is not the goal. Sustainability is what's happening mathematically, is compounding beginning to whisper instead of shout. Your contributions still matter more than returns, but returns are no longer irrelevant. The system is working, quietly, predictably, and that's exactly what you want. There's also a confidence that forms here, not the loud, reckless kind, but a calm one. You've survived ups and downs. You've stayed invested through boredom and volatility. You've proven to yourself that you don't need perfect timing or constant action to make progress. That confidence compounds just like money does. Reaching $10,000 doesn't make you rich, but it does something more important. It changes your relationship with money. You stop seeing investing as something fragile that could break if you make one wrong move. You start seeing it as a long-term engine that rewards patience more than intelligence. From here on, the process becomes less about starting and more about staying. And that's the real secret most people never learn. Wealth isn't built by dramatic decisions. It's built by ordinary ones, repeated after motivation fades. At $10,000, you're no longer just building an investment account. You're building inevitability. Crossing $25,000 feels different. Not dramatic. Not life-changing overnight. But different. This is where investing stops feeling like something you re-pushing uphill and starts feeling like something that moves with you. Up to $10,000, your contributions did most of the heavy lifting. At $25,000, market movement begins to matter in a noticeable way. A solid year in the market can add thousands without you increasing your effort. A rough year can test your patience in the same magnitude. The numbers are no longer small enough to ignore. This is the phase where compounding becomes visible. For example, at a 7% annual return, $25,000 can generate about $1,750 in a year. That may not replace your income, but it's meaningful. It might equal a month's rent, a car repair, a short vacation. The important part isn't what it buys. It's the realization that your money is now producing more money at a pace you can feel. That realization changes behavior. Many investors at this stage experience a motivation boost. Saving becomes easier because progress is measurable. Skipping an unnecessary purchase doesn't feel like deprivation. It feels like feeding something that's already growing. You begin thinking long-term almost automatically. But this is also where subtle risks emerge. One common mistake is lifestyle inflation. As income increases, spending rises proportionally. Contributions stay flat. The account grows, but not as fast as it could. At $25,000, the habit that got you here matters more than ever. If contributions grow with income, acceleration becomes powerful. If they don't, growth slows quietly. Another risk is complexity creep. Investors start adding multiple accounts, experimenting with speculative assets, or reacting to market narratives. There's nothing wrong with learning and evolving, but simplicity is still a competitive advantage. Broad diversification and low costs continue to outperform over long horizons. Psychologically, something deeper shifts at this level. Identity solidifies. You're no longer trying to invest. You are an investor. That internal shift reduces emotional swings. Market dips still sting, but they don't shake your foundation. You've seen downturns before. You understand cycles. Volatility feels like weather, not catastrophe. This is also when patience becomes your greatest asset. The temptation to accelerate aggressively through leverage, higher risk bets, or market timing can appear. The irony is that once compounding is working, the smartest move is usually restraint. Big risks are most dangerous when you finally have something meaningful to lose. At $25,000, time becomes more valuable than strategy tweaks. A 10% improvement in returns sounds exciting. An extra 10 years invested is transformational. The math favors duration more than optimization. There's also a quiet confidence that forms here. Emergencies feel less threatening. Long-term goals feel closer. The account is large enough to matter, but small enough to still be flexible. You're in a powerful middle ground where discipline still drives growth, but compounding is beginning to assist. And here, the overlooked truth. The leap from $25,000 to $100,000 often feels faster than the climb to $25,000 did. Not because it is easy, but because the engine is finally running at speed. Reaching $25,000 doesn't mean you've made it. It means the system is working. From here forward, wealth isn't built through dramatic changes. It's built by protecting what already works. Consistency, time, emotional control. At $25,000, investing stops feeling fragile. It starts feeling powerful.